By the time your direct deposit hits, three companies already took a cut: your lender, your landlord, and your credit card company. Welcome to the debt age. The thing is, when everything goes up but your paycheck, the gap doesn't disappear, it becomes debt. All forms of household debt are at the highest they've ever been, and young people are coming up at its worst. We didn't overspend, we were overcharged. So if debt is a business model, who's the customer and who's the product? Roughly 80% of Americans carry a credit card, and about half of workers live paycheck to paycheck. Why? Because when costs run ahead of wages for long enough, people don't adjust, they borrow. In the last 5 years, wages practically stayed the same, while productivity soared and prices jumped a quarter. Even then, that's not much compared to the almost 50% increase in home prices in the same period. So how are people dealing with these increased prices? In one word, financing. In 2025, household debt reached a record $18.6 trillion. Most of this debt is mortgages, about 70% of the total, with around $13 trillion owed on homes. But Americans also owe over $1.6 trillion in student loans, about $1.66 trillion in car loans, and more than $1.2 trillion on credit cards. So there's more credit card debt in the US than the GDP of any country not in the top 20. But how? It's because many households rely on credit cards to pay for necessities like gas, electricity, and groceries. It also doesn't help that credit cards now have some of the highest interest rates ever, averaging 22%. A lot of these people end up suffering from a debt spiral, where they can't afford their cost of living without going into debt and can't afford to pay off their debt because of their cost of living. Debt used to have a social stigma in the US, which it clearly doesn't have anymore. Over time, easy credit and stagnating real wages led to a boom in debt accumulation. Household debt went through the roof over decades. What does this mean? Well, if you had the same income today as in 1950, you'd be in over 4 times as much debt. This is a global and intergenerational issue, but no one feels it more than Gen Z. Let's take a look at some of the debt patterns we see and why it's so much worse for us young people. Over half of Gen Z in one poll said that debt is on their minds most or all of the time. A United Way study found that 69% of Gen Z adults say that inflation and the cost of living are their top financial concerns, unlike taxes or government spending like older generations. So it's unsurprising that Gen Z has the highest rate of debt increase of any generation. A big factor in this is student loans. Gen Z adults are about 10% of the US population, but make up 28% of student loan borrowers. College costs have ballooned so much that the majority of Gen Z with student loans say debt has forced them to delay major life goals, like buying a home or starting a business. Over 70% have even made career choices, like taking a job or staying in one, based on managing their student debt. So much for college setting you up for life. Another huge obstacle is that starting out Gen Z faces higher rents, insurance premiums, and basically higher cost everything than the generations before without the matching entry-level real wages. These factors cause Gen Z to heavily overuse credit cards to keep up. By Q3 2023, over 80% of Gen Z with a credit report had a credit card. Like many other things affecting Gen Z, it's the rate that's scary. In 2022 alone, Gen Z's average credit card debt jumped by more than 25%. Many of us use cards to protect against wage lag costs and cover everyday expenses, just like older Americans. But there have already been some cracks in the system, with Gen Z's delinquency rates rising. The share of their debts over 90 days past due is the highest it's been in 3 years. Credit rating agencies are reporting that Gen Z's average credit scores are trending downwards as they miss more and more payments. In fact, in February 2024, 33% of Credit Karma's Gen Z user base was at subprime credit, meaning a credit score below 600. And we're also getting into historically middle-aged debt much younger, like taking on auto loans to buy cars in an overpriced market. We're racking up debt faster than previous generations did at our age and struggling to pay it back. So of course we're anxious. It's hard to be optimistic when your starter pack includes debt, inflation, and a crash course on frugality. So Gen Z is more likely to budget, yet many end up in debt anyway, be it because of student loans, car payments, or other expenses that are hard to cover when first starting out. Polls show that Gen Z is increasingly financially pessimistic, with only 44% of us believing that we'll be better off than our parents. By the way, this is historically low. This kind of pessimism mixed with a consumerist culture turns every treat yourself into financial self-harm. Even then, we're still financially curious and savvy. We're regularly learning and sharing personal finance tips on social media, like TikTok and YouTube, but increasingly getting burnt out too. Our coping mechanism? Pretending burnout is entrepreneurship while moving back with our parents and refinancing student loans before the age of 30. Hashtag grindset. So it's no surprise when more than 85% of Gen Z workers report stressing over finances. Of course, companies and the government are taking full advantage, which just perpetuates the cycle that puts everyday people into debt spirals. But how exactly are people ending up in this predicament? Let's take a quick look at some of the tactics used against young people and people in general to get them to accept going into debt. Let's start with credit cards. Credit cards play a crucial role in US consumer finance, with more than 80% of adults having at least one and serving as one of the main methods of payment for most individuals. Credit card companies will often advertise things like 0% APR for 12 months. It's called deferred interest, and it's the old bait and switch. After you build up a big balance and forget, they jack up the rate and catch you utterly lacking with 20% APR. Most people don't pay off the balance in time and get stuck paying super high interest rates on the debt. And if you don't pay in full by the end of the promo, you get slapped with all the interest retroactively. There's also the minimum payment trap. Your credit card statement will often show minimum payments that are just 2% of the balance. Credit card companies know that showing you this amount will entice you to pay the smallest amount possible and kick the can down the road. Of course, these amounts are calculated to ensure that if you only pay the minimum, you'll basically be in debt forever. If you have, say, a $5,000 credit card balance at 25% APR and pay just the minimum, it would take almost 24 years to clear that debt and cost you $9,700 in interest. Oh, hell no! So paying the minimum is really paying the maximum. The thing is, credit card companies are looking for revolvers rather than transactors. Revolvers carry a balance month over month. Transactors pay their balance in full every month and treat a credit card like a short-term, no-interest loan. According to data from the Philadelphia Fed, the share of active accounts making only minimum payments hit a 12-year high in the fourth quarter of 2024. These revolving card balances alley-oop to another way they get you: fees. Missing a payment means a $30 late fee and possibly an interest rate increase. And if you cross your limit, they don't warn you, they fine you. Credit cards aren't the only loans that can bite people, though. Auto loans are extremely common and come with a lot of problems. More recently, there's been an increase in something called a negative equity rollover. Negative equity rollovers are when you roll your existing debt into a new loan for a new car. If you owed $5K more on your car than it's worth, they just add that additional $5K to your new car loan. More than a quarter of these car trade-ins were underwater, meaning the loan was worth more than the car. Dealerships are more than happy to do this since it sells out their lots and gets loans out the door. Of course, you end up with a loan that's worth more than your new car from day one. This puts people into endless cycles of debt, where they're constantly trading in old cars to get new ones. Dealers know the trick, giving 8-year-long car loans so that you'll trade the car before you ever own it. Then, you just end up working as an indentured servant for the car financing company. While auto loans may be big in the US, debt isn't just an American phenomenon. Personal debt has exploded worldwide. Global household debt is over 54% of global GDP. That's $59 trillion. In the rankings of countries by household debt to GDP ratios, the US is among the leaders, but not the top. Canada and Australia actually have higher household debt to GDP ratios, with each owing more than 100% of their GDP in debt. But the title of the highest in the world actually goes to Switzerland, with 125% household debt to GDP. The US is at 69%, which, while much smaller than Switzerland's, is still one of the highest in the world. Americans are deeply in debt, but like we said, a bunch of other developed nations are on the same boat or worse proportionally. Because of this, some countries like Singapore impose strict limits on how much people can borrow relative to their income and require high down payments for mortgages. Wouldn't want your population to accidentally recreate the American dream on credit, am I right? Culturally too, many East Asian countries and Singapore have higher savings rates and better family support systems than the US, leading to lower personal debt on average. Even then, that's starting to change. Let's take a look at China's debt situation. Chinese households traditionally avoided debt, but in the past 20 years, that's changed completely. Household debt in China went from 11% of GDP in 2006 to 60% today. That's wild when you realize this happened during their biggest boom years. Much of this debt, like in so many other places, is tied to their property boom. A lot of Chinese families took on big mortgages to get in on the property bubble. On top of that, a lot of their debt problem is still tied to consumer spending and online microloans. Young Chinese are increasingly participating in Western style consumerism and easy app based lending, including buying expensive things like cars, smartphones, and designer clothes on credit. The average Chinese millennial owes 120,000 yuan, or about 17,000 USD, in consumer debt. It's become so common in China that they've started a trend called debt IP, which is basically when people turn stories of financial ruin into a means of making money as online influencers. Some of the most popular accounts have hundreds of thousands of followers. It's reached the point where people are competing by saying, "Oh, I'm 10 million in debt. Well, I'm 100 million in debt." For a country that traditionally stigmatized debt, this is a huge change from just one generation ago. The CCP is trying to rein in on the lending and discourage people from reckless borrowing now, while at the same time realizing that increased economic growth and prosperity are key to them maintaining their grip on power. South Korea took it even further. Their national pastime became borrowing money to gamble in the stock market. Their central bank showed that those in their 30s are the most indebted relative to their income, with total borrowings amounting to about 270% of their annual income. This appetite for debt is what grew into a trend known as bitu, or borrowing money to invest. These young Koreans were borrowing money to invest in stocks or crypto, hoping to make it big and outpace their richer boomer parents. Of course, this whole situation kept getting worse and worse, to the point where in 2024, a stress debt service ratio framework was introduced to tighten borrowing. But some people just went to higher cost loans from non-bank financing institutions. The situation for the US is a bit different because of policy and cultural reasons, though. The US has a strategy of fueling consumer spending, especially through debt, to drive top line figure growth. A lot of the debt that American households have is related to key life expenses rather than just consumer spending. This, naturally, is related to social safety nets, or more accurately, the lack of them. In countries with free or affordable university, you don't see students with the massive student debt burdens that Americans have. Similarly, with robust healthcare systems, basically no one in a developed country goes bankrupt because of medical bills. Of course, that's not to say that countries with these social safety nets don't also have debt problems, like we just talked about. But anywhere you are in the world, if you're a young person living in a lot of debt, there are consequences, both personal and financial. So why don't we start with something uniquely American, skipping medical care due to cost? About 4 in 10 Americans report skipping or delaying medical care because it's so overpriced, which just leaves you with worse and more expensive health problems, and of course, possibly more debt. Almost 60% of Americans said they felt anxious about their finances at least sometimes, and a quarter felt their financial stress constantly. People with debt are 3 times more likely to suffer from depression or anxiety disorders compared to those without it. An HRO Today survey found that employees with financial stress lose over 7 hours of work productivity a week because of worrying about or dealing with money issues. Gen Z is even worse, with 8 hours of work productivity lost per week. We really are the best at everything we do. On an even more depressing note, the Aspen Institute found that 16% of unalivings are linked to a financial problem in the immediate background. That's thousands of lives a year. And another study found that having multiple sources of financial stress can increase the likeliness of a self-deletion attempt by up to 20 times. 20 times. Debt doesn't just exacerbate mental health issues either, it also worsens inequality. It's easier for rich people to pay off debt or avoid it altogether. In fact, rich people are able to use debt in ways that poorer people can't, like as leverage for investing into business loans or against their assets and then writing off the interest to reduce their taxes. This is completely different from things like payday or auto loans and credit cards with 20% interest. In effect, debt can become a wealth transfer mechanism from the poor with no assets who need debt to the rich who have equity in businesses like banks and financial institutions that give out these loans. Not to mention that it's harder to climb the socioeconomic ladder when saddled with things like credit card debt or student loans. We're at a point where 1 in 5 Americans have 0 or negative net worth. For these people, any type of emergency expense can ruin them financially. And sometimes, the only way to save themselves is with more debt, digging them further down the rabbit hole. It's a cyclical effect. Paying off debt makes it harder to save, and having no savings can force you to take on more debt to stay afloat. The biggest manifestation of this has been young people delaying life milestones, though. Home ownership rates for those under 40 have fallen to record lows these past few years, and debt is a contributing factor. Over 80% of Gen Z with student loans said they've put off investing for homes or businesses because of debt servicing, and 4 out of 5 millennials with loans have delayed marriage or having children because of it. The average age for first-time home buyers in the 80s was 29. Now it's almost 40, the highest it's ever been, partially because many people are stuck paying down their loans before they can reasonably start saving for a down payment. Since Gen Z and millennials have had a harder time investing and saving for traditional wealth milestones, they've been the first two generations who haven't outpaced their parents in recent memory. Those who are laden with debt have a harder time accumulating wealth during their prime working years, since they have to focus on paying off debt rather than wealth building. Compound interest is moving against them in the most important time for it to be working for them. This delay means that young people's wealth clocks start ticking a decade or two late. Ironically, a lot of these debts, like student loans, were taken with the intention of economic opportunity, but instead, they're holding back the very life they were supposed to be the ticket to. So, what does this look like on a macroeconomic scale? Most of the US's GDP is funded by consumer spending, about 70%. As household debts increase, it reaches a tipping point where people need to curb their spending to pay back off the debt. If these people start collectively holding back to pay it off, it could trigger an economic slowdown, which could turn into a much larger problem, and nobody wants that. The BIS, the central bank for central banks, has found that economies with higher household debt to GDP ratios tend to see deeper recessions when a downturn hits, since people in debt pull back hard when things get tough, causing that dreaded economic debt spiral. When debt chokes spending, the whole system suffocates. And people forget that too much debt can also cause social unrest, which has been the root of a lot of problems in society, like it has been for millennia. People that didn't take loans or paid theirs off are against relief efforts since they wouldn't get the same benefit. This fuels polarization, something we have more than enough of in the modern day. The thing is, when people feel like the game is rigged, like in 2008, when the big banks got bailed out and everyday homeowners had to deal with the consequences and taxpayers had to foot the bill, trust in the system erodes. We've already seen an uptick this year of large-scale movements around the world for this very reason. But before things get too off the rails, there are opportunities for citizens and their governments to make changes. In the US, student loans are the main battleground for policy around debt. So here are the facts. In the 2020s, the Biden administration pushed to forgive between $10,000 and $20,000 in student loans for most borrowers. Those for it argued it would wipe out the balances entirely for millions and reduce balances for tens of millions more, potentially freeing a generation or more from indentured servitude to their loans, stimulating the economy with their increased buying power, and try to help fight against rising tuition costs. Those against it argued it was unfair to those who didn't go to college or chose to forego debt to have to pay for the debt relief of the people who made the choice to take on loans. That it would alleviate the symptoms of the problem rather than remedy college prices being out of control, and that it could potentially encourage more people to take on loans because they could expect loan forgiveness later on. This political battle culminated in June of 2023, when the Supreme Court struck down the broad loan forgiveness program, ruling that the administration overstepped its authority. Because of the Supreme Court decision, the administration moved to other tools, namely an income-driven repayment program called the SAVE Plan. Basically, the SAVE Plan cuts borrowers' monthly payments by capping them to a smaller percentage of their incomes, and forgives remaining balances after a certain time if they're on time with their payments. As of today, these fixes have canceled over $127 billion in student loans for about 3.6 million borrowers. A large amount for sure, but still a fraction of the $1.8 trillion outstanding in student debt. And yet, student loans aren't the only topic where there's action. The Consumer Financial Protection Bureau fought to slash credit card late fees from the mid-30s and 40s to $8. This faced legal pushback from the banking sector and was later struck down by a court on technical grounds. Love that for us. Many people have also called to update bankruptcy laws, like allowing student loans to be discharged during bankruptcy like other forms of unsecured debt. On the flip side, there's also been massive lobbying to maintain the status quo since it benefits financial institutions. In America, the lender's right to collect often outweighs your right to recover. What's clear is this: the current system wasn't built for young people to get ahead. It was built for us to pay up. This brings up a more philosophical debate. Is managing personal debt an individual's responsibility and a direct result of their financial illiteracy? Or is it a societal issue that creates ripples downstream? I believe it's a bit of both, and people that say it's only one or the other are missing the nuance of the situation we're in. We have to decide if we want our economy propped up on consumer debt and a generation of young people on the financial edge, or if we want to take a different approach to help young people thrive. Speaking of thriving, the internet and meme culture have taken a stab at alleviating some of the pain of the situation. You'll find that a lot of Gen Z respond to crushing debt with dark humor, like we do with almost everything. From owing tens of thousands in student loans and then not getting the high paying job that was basically promised, to knowing that housing affordability is the worst it's ever been, we excel at making depressing shit hilarious. Memes like this one and that one show that Gen Z uses memes as a coping mechanism. It's basically meme therapy, since real therapy's not in the budget. But even therapy by meme has a downside. Joke about something long enough, and you start to accept it. But hey, people are actually learning financial literacy using these memes, especially people who wouldn't get that kind of education otherwise. Places like Debt Talk and Money Twitter are helping people learn about things like the avalanche and snowball methods of paying off debts while joking about credit card loans, or even turning comment sections into a space where people talk about tips for loan forgiveness. It's a rare glimmer of positivity on the internet. I started this channel to spread awareness of these issues and help young people learn about how the system works and what problems they should understand and avoid. That's why the channel name is In the Red. The debt crisis is often portrayed as something impossible to handle. People hooked on debt, companies using sneaky tactics to get people to spend money they don't have, and a younger generation with broken promises and a harder financial time than expected. It's ironic. We live in the richest era ever, but somehow everybody feels broke. We have a choice to make, both on a systemic and personal level. If everything stays the way it is, we could possibly see a future where Gen Z ends up as forever renters, working until their 70s with declining birth rates and economic recessions when debt bubbles burst. The first thing we have to do is acknowledge what's going on. That something must be broken when there's a collective household debt burden of $18 to $19 trillion. Whether the change comes from regulating the credit industry, investing in the next generation through financial literacy in schools, or some other solutions that we haven't come up with yet. It's important that we solve these issues before they become worse. Luckily, the shame that existed around the world about these issues has reduced a lot, allowing places like this channel to help spread education on topics like debt's crushing effect on young people. It's pretty funny. The same debt that fuels our growth also strangles the people who power it. It would be great one day to make a video titled, "We had a debt problem and fixed it," but that'll take some time to actually materialize. But for now, what can you do? Well, you can learn more about what's going on and ways that you can avoid debt or reduce your debt burden. So drop your best debt survival hacks in the comments. Misery loves company, but knowledge pays better interest. And remember,